What's up, traders? Welcome to today's Equity Empire chart analysis session. When most investors are throwing darts, we're looking for clues in the charts. My name is John McHugh. I'm a former Wall Street analyst, hedge fund manager, and independent trader for the better part of 20 years. Today, I'm going to be taking a look at gold futures. And the way we're going to assess this particular chart is twofold. First, we're going to assess the direction of the trend. Second, we're going to assess whether there are clues as to where the big funds are stacked up trying to buy or stacked up trying to sell. So step one, let's assess the trend. The way we're going to assess the trend is simply looking at the two most recent highs and the two most recent lows. So we'll start with this low here, move up to this high, drop down to our next low, and then climb back to our next high. The highs, as they move from left to right, are moving higher. The lows are also, as they move from left to right, also moving higher. That's the definition of an uptrend. A series of higher highs and higher lows makes up an uptrend. So we are in an uptrend. Now, let's move to step two, which is look for clues as to where the big funds are stacked up trying to buy and trying to sell. There's a nice looking clue here that the big funds could potentially be stacked up trying to buy in the 32.46 to 32.08 price range. So the trade there would be a potential entry point if price were to pull back to 32.46, protective stop just below 32.08, and then we could have our target. Since there's no clues of resistance anywhere up above there, we could set our target, let's just call it reward to risk ratio of 3 to 1. So that way we take one increment of risk for 3 increments of potential reward potential. So that would be a 3 to 1 reward to risk ratio potential setup in that trade if you were to take it. And then below there, if that trade did not work, or if you chose to enter in a lower support level, there's this beautiful support level just below the $3,000 price point on gold. And that's right here. That would be $29.98 to $29.70. So the way we would set up that trade would be putting a buy limit order at the $29.98 price range, protective stop just below the $29.70 range, and we could have our target all the way up to basically the current prices. So if you were to wait patiently, if we're to pull back all the way down to 3,000, which or may not, but if you wanted to be patiently wait and maybe not get a trade put on for some time, you could enter that price range there, and that would be about a 9 to 1 reward to risk ratio on that trade. So what we've done here today is we have assessed the trend. We have assessed two potential entry points based on clues that institutions could be stacked up trying to buy in this level here and that level there. And both of those trades would have very high reward to risk ratios. So, hope you enjoyed today's session. Hope you learned a little something if you're new to trading. I'll be back tomorrow for another chart analysis session. Until then, best of luck in your trading and investing, and we'll see you soon.